Tesla beat earnings. Alphabet beat earnings. Both reported results that were stronger than Wall Street expected. Yet both stocks still sold off. If you were ever wondering why a company can post great numbers and still see its share price fall, this week's earnings season offers the perfect lesson. Alphabet reported nearly $120 billion in quarterly revenue, comfortably beating expectations, while Google Cloud revenue surged an impressive 82% year over year, showing that demand for AI infrastructure remains incredibly strong. Tesla, meanwhile, delivered a record 480,000 plus vehicles and also exceeded revenue expectations. On the surface, these looked like outstanding quarters. But the market wasn't focused on what these companies achieved. It was focused on what they plan to spend next. Alphabet raised its full year capital expenditure guidance to 195 to 205 billion dollars, significantly above its previous forecast as it accelerates investments in AI data centers and computing infrastructure. Tesla is following a similar path, pouring billions into AI compute, robotaxi development, the Optimus humanoid robot, and manufacturing expansion. These massive investments are putting pressure on free cash flow, raising an important question for investors. When will all this spending start generating meaningful returns? And that's the key lesson every investor should remember. A company beating revenue or earnings estimates does not automatically mean its stock will go up. Stock prices are driven by expectations, future cash flows, and valuation. When investors believe spending is rising faster than future profits, they start worrying about returns on that capital, even if today's business looks fantastic. Companies like Alphabet and Tesla aren't struggling. They are making one of the biggest investment bets in corporate history on artificial intelligence. That bet may create enormous value over the next several years, or it may take much longer than investors expect. And that is exactly what the market is trying to price in today. So the next time you see a stock fall after reporting great earnings, remember this: the market doesn't reward the past, it prices the future. If you like this video, subscribe, comment, and share. Free equity analysis course link in the description. Thank you.